Here are two ways where you can judge the performance of a private equity investment. So if you're a limited partner, or if you're looking to invest in a private company by yourself, here are ways where you can judge and score and kind of rank yourself to see, is this investment performing well, and is it worth the added level of risk and potentially illiquidity of this investment? So two measurements that are used. The first one is internal rate of return, and the second one is MOIC, M-O-I-C, multiple on invested capital. So the first one, internal rate of return, basically what you're looking at there is how much money you put into the deal compared to how much money you put out of the deal and the amount of time that it took to get that return. So the longer holding period, the lower your internal rate of return will be. So if you have a gain on an investment and they're able to quickly liquidate that investment, that would lead to an higher IRR. So typically, if you're looking at a private investment, you want your IRR to be somewhere between 15 and 20%. So that way it's paying for that added level of risk, that added level of illiquidity, and that should get you a little bit of a premium over publicly traded stocks. The second measure is MOIC, so M-O-I-C, and that one is pretty easily defined. So multiple on invested capital means here's the amount of money that you put into the deal, here's the amount of money that you got out of the deal. What was that percentage? And what was that multiple, so to speak? So if you put $100,000 into a deal and you get 3x MOIC, essentially you would get $300,000 out. So looking at MOIC, that's one way to determine before you're making the investment. You should ask either the firm, the business owner, or whoever you're investing with, what can be our expected MOIC? So what would be the multiple on this money that I'm giving you that I should expect to see at the time of an exit?